Okay, I think we can start. I want to welcome everyone to this World Economic Outlook press briefing, the first press briefing in person since the start of the pandemic. We're very happy to see a full house here with us. I also want to welcome those who are joining us today online. I'm José Luis de Haro with the Communications Department here at the IMF. I hope that this time you already have access to a copy of the World Economic Outlook released today. It's available at imf.org, and joining us today are Pierre-Olivier Gouguin-Cha. He's the Economic Counselor and the Director of the Research Department. With us today too, Petya Coeva-Brooks. She is the Deputy Director of the Research Department, and Daniel Lee, he's Division Chief also at the Research Department. Pierre-Olivier, it's going to start with some opening remarks, and then we will open the floor to your questions. I want to remind those joining us online that we will be taking questions from them too. And also, I want to remind everybody online and here in the room that we have several languages interpretation. Without further ado, Pierre-Olivier, the floor is yours.
Thank you, Jose, and good morning, everyone. The global economy continues to face steep challenges shaped by three powerful forces: the Russian invasion of Ukraine, the cost of living crisis caused by
Официально объявила, что прекращает экспорт электричества в Евросоюз из-за повреждений инфраструктуры. Остановка экспорта существенно ударит по бюджету Украины и кошелькам рядовых европейцев. Счета за электричество вновь вырастут, причем еще больше. Основными потребителями...
to 1% in 2023. In China, we have lowered next year's growth forecast to 4.4% due to a weakening property sector and continued lockdowns. The slowdown is most pronounced in the euro area, where the energy crisis caused by the war will continue to take a heavy toll, reducing growth to 0.5% in 2023. Almost everywhere, rapidly rising prices, especially for food and energy, are causing serious hardships for vulnerable households. Despite the slowdown, inflation pressures are proving broader and more persistent than anticipated. Global inflation is now expected to peak at 9.5% in the third quarter of 2022, before decelerating to 4.1% by 2024. Inflation is also broadening beyond food and energy. Global core inflation rose from an annualized monthly rate of 4.2% at the end of 2021 to 6.7% in July for the median country. Downside risks remain elevated, and policy trade-offs have become acutely challenging. Here are a few of the ones we highlight in our report. The risk of monetary, fiscal, or financial policy miscalibration has risen sharply at a time of high uncertainty and growing fragilities. Global financial conditions could deteriorate and the dollar strengthen further should turmoil in financial markets erupt. Inflation could yet again prove more persistent, especially if labor markets remain extremely tight. Finally, the war in Ukraine is still raging, and further escalation can exacerbate the energy crisis. Our October World Economic Outlook report presents a risk assessment around our baseline projections. With 25% probability, global growth next year could slow down to below 2%, a historically low level. We've only had that 5 times since 1970. If many of the risks materialize, global growth would decline to 1.1%, with quasi-stagnant income per capita next year. According to our calculations, the likelihood of such an adverse scenario would be around 10 to 15%. Increasing price pressures remains the most immediate threat to current and future prosperity by squeezing real incomes and undermining macroeconomic stability. Central banks are now laser-focused on restoring price stability, and the pace of tightening has accelerated sharply. There are risks of both under and over-tightening. Under-tightening would further entrench the inflation process, erode the credibility of central banks, and de-anchor inflation expectations. As history repeatedly teaches us, this would only increase the eventual cost of bringing inflation under control. Over-tightening risks pushing the global economy into an unnecessarily harsh recession. Financial markets may also struggle to adapt to an overly rapid pace of tightening. Yet the cost of these policy mistakes are not symmetric. The hard-won credibility of central banks would be gravely undermined if they misjudge, yet again, the stubborn persistence of inflation. This would prove much more detrimental to future macroeconomic stability. Where necessary, financial policy should ensure that markets remain stable. However, central banks around the world need to keep a steady hand, with monetary policy firmly focused on taming inflation. Formulating the appropriate fiscal response to the cost of living and energy crisis has also become a serious challenge for many countries. Let me mention a few key principles. First, fiscal policy should not work at cross purpose with monetary authorities' efforts. Doing otherwise will only prolong inflation and could cause serious financial instability, as recent events reminded us. Second, the energy crisis, especially in Europe, is not a transitory shock. The geopolitical realignment of energy supplies in the wake of the war is both broad and permanent. Winter 2022 will be challenging, but winter 2023 will likely be worse. Price signals will be essential to curb energy demand and stimulate supply. Price controls, untargeted subsidies, or export bans are fiscally costly, lead to excess demand, undersupply, misallocation, and rationing. They rarely work. Fiscal policy should instead aim to protect the most vulnerable through targeted and temporary transfers. Third, fiscal policy can help economies adapt to a more volatile environment by investing in productive capacity, human capital, digitalization, green energy, and supply chain diversification. Expanding these can make economies more resilient when the next crisis comes. Unfortunately, these important principles are not always guiding policy right now. The strength of the dollar is also a major challenge. The dollar is now at its strongest since the early 2000s, mostly against advanced economies, but also against emerging markets. So far, this rise appears mostly driven by fundamental forces, such as the tightening of monetary policy in the United States and the energy crisis. The appropriate response is to calibrate monetary policy to maintain price stability while letting the exchange rate adjust, conserving valuable foreign exchange reserves for when financial conditions really worsen. In other words, as the global economy is headed for stormy waters, now is the time for emerging market policymakers to batten down the hatches. Eligible countries with sound policies should urgently consider improving their liquidity buffers, including by requesting access to precautionary instruments from the fund. Countries should also aim to minimize the impact of future financial turmoil through a combination of preemptive macroprudential and capital flow measures where appropriate, in line with our integrated policy framework. Too many low-income countries are close to or already in debt distress. Progress towards orderly debt restructuring through the Group of 20's common framework is urgently needed to avert a wave of sovereign debt crisis. Time may soon run out. Finally, the energy and food crisis, coupled with extreme summer temperatures, starkly remind us of what an uncontrolled climate transition would look like. There are clouds on the horizon, but progress on climate policies, debt resolution, and other targeted global issues will demonstrate that strengthened cooperation can achieve progress for all and help to overcome geoeconomic fragmentation. Thank you.
Thank you, Pierre-Olivier. Before we open the floor to your questions, some ground rules. If you want to ask a question, raise your hand. wait till I call on you and somebody will give you the mic. Try to stick to just one question. We have a full house here today. If you have any follow-ups, we can treat those bilaterally. And with that said, I think we're going to start here in the front. We're going to start with Andrea Shalal, Reuters.
Thank you, Andrea Shalal with Reuters. I wanted to follow up on your remarks about the debt crisis. You say that time is running out. I mean, it's been years now since the Common Framework was set up, and there's only been 3 cases. They haven't been finished yet. What can you do here as an institution to put more emphasis on that and to increase the momentum? And do you see any signs that the private sector, lenders, creditors, and China are willing to move?
Well, I think you're pointing out that there is effectively a serious issue of debt restructuring that is needed for a number of especially low-income countries. The Common Framework has been put in place, as you pointed out, by the Group of 20 a number of years ago. Only 3 countries have approached the Common Framework. There's been progress. For a long time, not much was happening, but there's been progress recently, especially in the case of Zambia, and I think we want to point that out. And more progress is needed. The hope is that somehow the progress that can be made with a country like Zambia can also help facilitate the process for other countries in the future. There's no doubt that many countries need to engage in discussions with their creditors, need to approach them, they need to approach the fund to start thinking about how to reduce unsustainable debt levels. And we certainly encourage countries to do that. For the low-income countries, the Common Framework can help. For others, they can form creditor committees or approach their creditors to form creditor committees and try to make progress on this.
Thank you, Pierre-Olivier. We're going to stick here in the front, and then we will move around the room. Xinhua?
Thank you for taking my question. It's Maolin Zhang with China Xinhua News Agency. I want to ask about the climate transition. The report mentioned that climate policies might have some modest adverse impact on the near-term economic activity and inflation. But if we delay the action, there is going to be more cost. It's going to be catastrophic. And what's your reaction to the argument that right now we're facing multiple challenges, we need to address the crisis immediately, and then maybe we can worry about climate policies later on? Why the urgency? Thank you.
Yes, we have in our World Economic Outlook an entire chapter on the near-term cost of the macroeconomic transition. And an important point here is to emphasize the main message from that chapter, which is that there are some costs of doing the macroeconomic transition, the climate transition on the macroeconomic side. These costs are very, very modest in comparison to the cost of not doing the climate transition, everything that would happen if climate and temperatures increase in an uncontrolled fashion. Now, sometimes we hear, well, we see with the energy crisis, for instance, we see what happens when there is a very high energy price. It's very disruptive for macroeconomic policy. And one of the things that this chapter emphasizes is the climate transition is of a different nature. It's a gradual process, and the gains are much larger if that process is started early. So yes, we have to deal with the energy crisis right now. Yes, a number of countries are facing themselves in a situation where they need to procure more energy to produce electricity over the winter, etc. But the path that we should embark on in terms of the climate transition is something that we cannot ignore as well, and it doesn't require that we do all of the adjustments up front, but that we engage on a credible path towards achieving our 2030 objectives.
Okay, we're gonna stick with the front and then move around. Colby, FT.
Colby Smith with the Financial Times. The report repeatedly mentions the need for central banks to stick with their monetary tightening plans in order to ensure that inflation does not get further out of control. But given that we've already seen significant front-loading and there are lags associated with any kind of monetary policy changes, I'm curious if you think it's time for central banks like the Fed to moderate the pace of rate hikes from the 75 basis point clip and think about something a bit more measured.
Well, what we are recommending is that central banks stay the course. Now, that doesn't mean that they should accelerate compared to what they've been doing, if we think about the Fed, for instance, but it also doesn't mean that they should sort of pause on the path towards monetary normalization that we've seen. Let's step back for a minute. We are not starting from a position where central banks were in neutral when they started increasing rates. We're starting from a position where rates were historically low because countries were coming out of the pandemic. So a lot of what we've seen so far is monetary normalization, central banks coming closer to sort of a neutral stance, which is very appropriate given that the economy is not in the COVID-related recession anymore and that you have disinflation pressures. Now, you're absolutely right that there are lags in the transmission of monetary policy, but we also have a very elevated level of inflation, and when you look at core measures of inflation, they are still pushing upwards. So it's a little bit early to think about moving to something else. I think right now our advice is let's make sure we see a decisive decline in inflation, which, by the way, in our forecast, we're seeing happening, inflation peaking around now or towards the end of the year, depending on the countries, and then in 2023, inflation coming down, conditional on the path for monetary policy that countries have implemented. So this is how I want to explain what we mean when we say stay the course.
Eric Martin, Bloomberg.
Yes, thank you very much. Dr. Goran-Shah, I wanted to ask you about the downside scenario modeling regarding the global pandemic. And in the last couple of years, the danger of new variants has been one that's been very prominently flagged in the global outlook. It's mentioned in this outlook, but fewer than about a half dozen times. And I wanted to ask about, we're all meeting here for the first time since 2019 in person. How confident is the IMF regarding the outlook for the global economy in light of COVID and the possibility of new variants? Last year the vaccination was an issue that was flagged very strongly by the IMF last summer. How does the fund view the distribution of vaccines and just the global public health response? And is the worst, is the worst of the risk behind us? Or are you concerned about, this winter and things like Omicron, other virus issues cropping up?
Well, thank you, Eric. Certainly the risk of further variants or resurgence of the pandemic is something that we mention in our report as one of the downside risk. We haven't included it in our adverse scenario modeling. We've included other risks which we thought were maybe more immediate risks that the global economy was likely to face, but it's certainly one of the risks we highlight. Now, it is the case that as of now, most countries have reopened, and as we can attest today that activities have sort of resumed on a quasi-normal course. There are a few exceptions to that, and of course, obviously, an important exception is China, where a different health policy path has been charted, and as a result, the country is still facing continued localized but important sometimes lockdowns, and that's something that is weighing down on Chinese economic activity in our baseline forecasts because of the continuation of the zero COVID policy.
Larry Elliott, The Guardian.
The Bank of England has been stepping into the bond market in the UK today to prevent disorder and disruption. How much of that is the consequence of the Chancellor's fiscal package on the 23rd of September, which announced unfunded tax cuts and a blanket support for energy users? What are the spillover risks to the global markets? And what advice would you give to the Chancellor when he comes up with another fiscal package at the end of this month?
Well, very important question. We've seen a lot of turbulence in the gilt market of late. Certainly our advice to countries, as I've mentioned in my opening remarks, is that fiscal policy should be aligned with the objectives of monetary policy. And it's a little bit difficult if you think about central banks that are trying to tighten monetary policy and if you have at the same time fiscal authorities that try to stimulate aggregate demands, like having a car with, two people in the front and each of them has a steering wheel and is trying to steer the car in a different direction. That's not going to work very well. So our advice has always been that fiscal policy should be cognizant of the central bank's efforts and should try to be as close to neutral as possible. Now, what we've seen in the UK market, we've seen market dysfunction related to some illiquidity in some segments, and you may want to attend Tobias Adrian, financial counselor, press conference for the GFSR later today, where he will also talk about this from the market perspective. And so there's been a need for the Bank of England to come in and address the market dysfunction. Central banks have a financial stability mandate. They need to do that. And so the Bank of England is sort of navigating these dual objectives. On the one hand, continuing on the path towards monetary tightening that is needed to address the inflation pressures, and at the same time addressing pockets of market dysfunction that may be arising, in the particular case of the UK, maybe due to the pension funds and the liability-driven investment. Having said all of this, it's very clear that stability can be improved, both in the financial markets and more broadly, with a fiscal package that is going to be consistent with what the Bank of England is trying to do. And from that perspective, we certainly welcome the government's announcement of a fiscal event at the end of the month, and the involvement of OBR in assessing making the forecasts on those fiscal plans.
I see two virtual hands on WebEx, our friends from GK News and TASS. Please, where you can go first, and then Anton, you can go second. Formulate your questions, we compile them, and our friends here can answer.
Thank you. So I had a question on the dollar strength. As the dollar continues to rise amid the Fed's tightening cycle, what are the spillover effects? We see some major central banks stepped up to support their currency. So is it necessary or possible for us to have another Plaza Accord sometime down the road? And as a result of that, at this point, to what extent are you worried about over tightening? Thank you.
Yes, so you're absolutely right. The strength of the dollar is certainly putting a lot of strain on a number of countries. I mean, it works through two channels. One, it's making the price of imported goods, which often are invoiced in dollars, higher, and so that's increasing inflation pressures in other countries. And then it's also tightening financial conditions. A lot of corporates or governments have dollar debt, and that becomes more expensive to service as the dollar appreciates. Now, at the same time, what's important to ask is why is the dollar strengthening? What are the sources of the dollar strengthening? And here at the fund, in a sense, we're separating between what we call fundamental forces and what might be market disruptions or financial turbulence. A lot of what we're seeing right now is really on the side of fundamental forces. It's really the fact that the Federal Reserve has increased interest rates quite aggressively in 2022 so far, is expected to do more compared to other countries. And it's also reflecting the energy crisis, that a lot of energy importers are impoverished by the high price of energy, and that is reflected in the weaker currency for them. So these are fundamental forces. And in a sense, countries need to adapt to them. They need to sort of take that into account. And the appropriate response there is not to try to stem the dollar appreciation that results from this, but really to try to have countries sort of cope with it and let the adjustment happen by targeting domestic policy. Now, the second leg, if you have financial market disturbances, if you have a taper tantrum type of event, then that would justify, under some conditions, that would justify, using FX foreign reserves interventions or deploying other instruments to try to limit that volatility. But in many countries, we're not there yet.
We have another virtual hand. Anton, please go ahead, formulate your question.
Good morning. Thank you for doing this. As IMF once again increased the projection for Russia's GDP in 2022, it was minus 6%. Now it's minus 3.4%. So it's not so severe recession as it was expected. In this regard, is it possible that by the end of this year, the efforts of the Russian authorities would result in a very low recession, if any? Thank you.
Yeah, so Anton, yes, you're right. I mean, we have revised upwards our numbers for Russia But we still are projecting a decline in economic activity in 2022 and another decline in 2023. So the economy is not only lower in 2022, but it's going to keep shrinking in 2023. And in fact, if you extend the forecast further, we're not expecting a rebound here. But let me turn it over to my colleague Petya Koeva-Brooks, who can answer in more detail on Russia.
Sure. There are several reasons why the contraction in the recession is milder than we had previously predicted. First is that the energy exports have held up as a result of diversion of those exports to non-sanctioning countries. The second reason is that the government's footprint in the economy is large, and the employment level is actually at pre-crisis levels. The third reason is that the appreciation is the appreciation of the ruble, which has made inflation lower than previously predicted, and of course had its corresponding effect on real incomes. And last but not least, there's been very large policy support provided by the authorities in the form of fiscal stimulus, as well as a decrease in the policy rates. All of that being said, again, we should emphasize that the impact of the war and the associated sanctions is having a major toll on the Russian economy. And if you look at the level of output at the end of this year, in the last quarter, and compare it to what was predicted prior to the war, the gap is about 9%. And that gap gets larger over the medium term. Thank you.
We're going to continue here, then we're going to move there. Andras, Der Standard.
One and a half questions. One is, the Economist ran a big piece this week that we're entering a completely new phase on the global economies, growth going down, interest rates rising, central banks not able to do anything. Could you elaborate a little bit on that, if that's true? And second part, short question, at the beginning of December, there will be kicking in an embargo on Russian oil for services regarding Western companies. What do you expect of that coming out? Thanks.
Yeah, so very clearly we're in a very different phase. The global economy is dealing with elevated inflation. That requires the monetary tightening that we're seeing. That's going to slow down growth as we're projecting for next year. That's going to be an environment with higher real rates, not just nominal rates, but real rates are also going to be increasing. And next year, you're going to have a combination of growth that is slowing down and inflation that is still quite high and it's coming down, but still from high levels. There are other forces that are, people talk about, are we seeing a change in regime? One concern, for instance, is what could happen, maybe not in the immediate future, but further down the road, with fragmentation risk. Are we about to see a reconfiguration of supply chains because of geoeconomic fragmentation? That's something that is certainly a worry. That's something that we would certainly not want to see. We would like to see diversification of supply chains so that economies can become more resilient, but certainly not the emergence of anything that looks like blocks. So there are a number of forces here that would push in the direction of maybe slowing down growth and higher interest rates. Some of them are more cyclical, some of them are maybe more long-term. Now, on your question on Russian oil, I mean, it's something that the price cap that was announced in the sixth package of sanctions by the European Union is something that is part of our forecast round. But the discussions are currently going on about the implementation of the price cap exemption. That is not something that we have in our round. And there is quite a bit of uncertainty about how energy markets are going to evolve in the coming month, with both what's happening in terms of the sanctions on one side and what's happening with energy producers on the other side. So there's quite a bit of uncertainty. And that's one of the layers that we added in our adverse scenario in the WEO, where we thought about, well, what would happen if you have an increase in oil prices, for instance, that would feed into inflation, would create another supply shock. And our model-based estimates suggest that this would shave off another 0.5% of output levels next year. So this is quite significant if you think about the impact that something like a 20 to 30% increase in oil prices would have on the global economy.
As promised, we're going to go to this side of the room. The gentleman on the second row with a blue tie.
Good morning. My name is Obin Nachima, this day newspaper in Nigeria. As you are aware, inflation is ravaging a lot of countries, and it appears most central banks in Africa have reached their limits. And you also mentioned the fact that there's a time lag in monetary policy transmission. Would you advise central banks to deploy both conventional and unconventional methods in the fight against inflation? Thank you.
Well, our advice in general is that central banks should first start with the traditional instruments of monetary policy. And as you want to think about non-conventional instruments, then you should think about what is a friction that is preventing conventional monetary policy from working, that would require a country or a central bank to deploy alternative ways of charting a course for monetary policy. So that's sort of the general high-level advice. Now, in terms of individual countries and for Africa, maybe I will turn it over to Daniel Lee here, who will answer for us.
Yes, thank you. So for Nigeria, in particular, we have forecast our inflation of about 19% for this year, but then some moderation next year down to 17%. And part of that does reflect the monetary policy actions, the 4 percentage point increase in Nigeria's central bank, as well as the decline that we expect in oil and food prices globally.
Okay, we're going to continue there. The friend, the reporter on the third row.
Stefania Splatti, Class CNBC. My question is about Italy, and I was wondering if you can elaborate on your estimate, especially for next year. What are the main risks you can see for the outlook of the country, and if you have any policy recommendations for the upcoming new government? Thank you.
Thank you. So for Italy, just let me start by saying that this is one of the countries where we had a positive revision for 2022. I mean, a number of European countries did better than we expected in our previous round of projections. Italy is one of them. Stronger tourism, strong activity in general, and so in construction as well. Now, Italy we're projecting a very sharp slowdown for next year. Italy, we're projecting actually a negative growth rate for 2023. And in large part, this is due to energy prices and the dependence that Italy has to gas. And we're also seeing the impact of the tightening of monetary policy in the euro area and also weak external demand. But let me turn it over to my colleague Petja, who can also answer on Italy.
I don't have much to add except to say that actually in Italy we are expecting Italy to enter a technical recession in the coming quarters, and a big impact has come from the energy crisis and the elevated inflation and the adverse impact on real incomes. So when it comes to the risks to this outlook, they are again very much on the downside, and again they are related to even further impact coming from energy markets. And then when it comes to the advice, I think it is basically like in many other countries to focus on providing support to the most vulnerable as opposed to broader measures, keeping in mind the at-risk fiscal space and making sure that debt is on a declining path in the medium term.
We're going to go with Paula F.
Thank you. I have a couple of questions. First of all, I would like to know more details about Spain's forecast. We see that it's the Eurozone country that is growing more, but next year previsions are not that well. What is going to happen? And apart from this, I would like to know more details also about Latin America. Which are the economies that will resist better the crisis, and also what is going to happen next year? Thank you.
Yeah, so Spain is in some ways, in terms of just the broad outlook, of course there are many, many important differences, but in terms of the broad outlook, it's a little bit similar to Italy in the sense that we had also an upward revision, and Spain did very well in 2022 with a growth of 4.3% that we're projecting as of now. strong tourism. And 2023, the same forces that are weighing down on Italy are also weighing down on Spain. So energy, of course, weak demand, and the tighter monetary policy. All of these, so the combination of these three things is weighing down. Now, in terms of Latin America, what we have in Latin America is a little bit of heterogeneity, but we have a group of a region that has actually fared pretty well also. A number of them had started tightening monetary policy well ahead of advanced economies. So if you think about countries like Brazil or others, they started tightening policy quite early already in 2021. And so they were ahead of the curve a little bit there. And so some of them were also propped up by high energy and commodity prices. And so that buffered them in 2022. But let me turn it to Petja to provide maybe a little bit more granular details.
Sure. So on Spain, indeed, the pattern is the same, similar to other European countries, but the growth rates are significantly higher. So we're talking about 4.3 for this year and 1.2 for 2023. And Spain is a country where the European new generation funds are expected to also boost activity. One caveat here is that the second quarter data was actually released after the cutoff for the forecast was made. So if that forecast were done now for 2023, we would probably see even higher numbers than what we currently have. And when it comes to Latin America, we have upgraded the forecast for this year to 3.5 and downgraded modestly the forecast for 2023 to 1.7. And again, this is a region that's exposed to commodity price developments, to external demand, and to tightening financial conditions, as well as many countries depend on remittances as well as tourism. So it's a little bit of a heterogeneous picture.
I want to take this opportunity to remind everyone that we will be hosting a series of regional press briefings over the week, so you can keep asking country-specific questions by then. But talking about country specifics, we have a couple of questions online about Egypt. What are your expectations for the Egyptian economy in 2023? How you see the Egyptian central bank actions to reduce the inflation in light of the economic crisis? This question comes from Fatma Ibrahim Aman.
I will turn it over to Petja also.
Sure. So Egypt, like many other countries, has been affected by the global slowdown and the tightening financial conditions. It's also a country that has experienced large capital outflows. So in that context, with heightened inflation, the measures to hike interest rates and to tackle inflation, we think are appropriate. In terms of the growth forecasts, we have downgraded our forecast for 2023 to 4.4, and there are risks, of course, on the downside related to tightening financial conditions, as well as the broader challenges that come from the worsening external environment.
We're going to go to our reporter there with a mustache.
Thank you. This is Lalit Jha from PTI, Press Trust of India. I wanted to ask you about India and how India's digitization program has helped its economy, in particular the direct cash transfer and other efforts that the Indian government has done. Thank you.
Yeah, so India has been doing fairly well in 2022 and is expected to continue growing fairly robustly in 2023. We have a growth rate at 6.8% for this year, and the projection at 6.1% for next year. Now, this year there is a downward revision, and it's mostly due to the external outlook as well as tighter financial conditions. And the growth revision for the first quarter of the fiscal year came in weaker than previously expected. Inflation is still above the central bank target in India. It's at 6.9% we project for this year, and coming down to 5.1%. So the overall stance of policy, we think that fiscal and monetary policy should probably be on the tightening side. Let me maybe ask Daniel if he has any additional points to make.
I have very little to add. We do expect that inflation will come back to the inflation tolerance band, 4%, in fiscal year 2023-2024, and additional monetary tightening is going to ensure that that happens.
This is the last question, and it's going to go to the reporter back. Yeah.
We don't have a lot of questions on Africa. I don't know how you choose.
Do you? Can you wait your turn? Do you want to ask a question on Africa? Then you will have the last question, but please let the colleague to ask his question. Thank you.
All right, thank you. Shabtai Gold at DevEx. I just wanted to go back to the food price issue. Your report highlighted some concerns there, particularly about additional shocks and what that would mean. We're seeing wheat prices moving back up. The dollar is getting stronger as policy tightens. That's likely to continue. Maybe in just qualitative terms, you can just tell us for emerging markets, for low-income countries, how bad is it going to get?
Well, food prices have certainly increased substantially in the last year, and that has created a lot of hardship, especially for low-income households for whom the food and energy component of their basket is very important. So that's an important concern. Of late, food prices had started to turn around and come down. There had been some positive developments. For instance, the Black Sea grain deal that was implemented over the summer that allowed the exports of Ukrainian wheat. And some of the increase you've seen in the last few days reflect some uncertainty maybe about the continuation of that deal, given the situation in Ukraine. And in a sense, this is, as I mentioned, this is one of the risks that we highlight, is that you could have a lot of uncertainty in food and energy markets related to the war. Now, on this, I would like to mention that the fund has just opened its food shock window, which allows a number of countries to access emergency financing to deal precisely with elevated food prices. And so this is just sorted. And a number of countries, we expect a number of countries will be able to access funding through that new facility that is part of the emergency funding we have. I also want to flag that we have in our World Economic Outlook, there is a whole special feature on precisely understanding the drivers of food inflation that does a deep dive into some of the drivers going forward.
Go ahead.
Thank you, Jose. Thank you for taking my question. This is Simon Ateba with Today News Africa. I understand that you guys like to talk a lot about the war in Ukraine and how that crisis is exacerbating the food crisis around the world. But in the Horn of Africa, we are facing the worst humanitarian crisis on earth at the moment because of drought, the devastating war in Ethiopia's Tigray region and everywhere. I was wondering if you could talk first about the Horn of Africa and the economic outlook there and what the IMF is doing to help the millions of people there who are affected. Again, as I said, the people in Ukraine, they are white, they are in Europe. It makes perfect sense for you guys here to talk a lot about them. And if you can talk a little bit also about Africa, the debt distress, what you guys are doing to help African nation, the economic outlook on Africa, and what is being done here in Washington. Thank you.
Let me address this question. So first, you're absolutely right. The current environment has interrupted the growth rebound that we had in many parts of Africa. And growth is expected to slow down in the region. And as we've just discussed, this is creating a lot of hardship for a lot of people. Now, the fund is doing a lot. We had, a year ago, we had an SDR allocation that allowed, that distributed SDRs to countries, 650 billion. There is a resilience and sustainability trust that is being put together that will allow countries to access funding for climate-related and long-term projects which are going to be particularly relevant, to deal with climate change and regions where you have droughts and problems with very low yields or extreme weather events. There is the food shock window that I just mentioned. So there are a number of facilities that we are putting together to address some of the balance of payments imbalances that are rising in countries, because this is what the fund does. And we are, at the end of the day, we are here to help countries that have balance of payments imbalances, and there are a number of reasons why they might have them. Some of them might be related to food prices, some of them might be related to climate, some of them might be related to other types of shocks. Let me maybe turn it over to Daniel on provide a little bit more specifics on Africa.
Yes, thank you. It is a region very severely affected by the war in Ukraine. The food, fuel, and fertilizer price spike is having a negative effect on agriculture and a broad part of the economy. On top of that, this is one of the parts of the world where the COVID shock is still really severe in terms of the very low vaccination rates, 26% only in sub-Saharan Africa compared to 66% in the rest of the world. Only 2% have a booster compared to a third to a half in the rest of the world. So on top of that, the global slowdown means less demand for the products of the region. And then on top of that, the higher interest rates, low growth means that 2/3 of the countries in the regions are facing stress or debt distress. So this is why the attention here is very much on providing relief, also in terms of supporting the common framework to avoid the debt crisis from spreading.
I want to thank you, Pierre-Olivier, Petya, and Daniel for the time. And in the name of the Research Department and the Communications Department, I also want to thank you all for attending this briefing. I want to remind you that the next briefing for the presentation of the Global Financial Stability Report is going to be in this exact same venue at 10:30 a.m. And if you have any questions or additional comments, please send those to media@imf.org. Have a good rest of your day.